Welcome to Top M&A Entrepreneur. I have my guest, my bestie, Holli, my CFO strategist, to talk about how to spot fraud in an SMB. 7 red flags. Welcome, Holli.
Thank you so much for having me at Top M&A. Listen, this is a topic after my own heart, and I'm excited to talk about it today. So we're back together again.
Oh, by the way, if you get onto LinkedIn, definitely follow some of her because she just visited a client and talks about some fraud she found and millions of dollars over a period of years, and kind of a forensic investigator there. There you go.
Yeah.
So let's get into this. I'm going to share a screen. How to spot fraud when buying an SMB. 7 red flags. You ready?
Okay, so yes, I'm ready. So what percent of transactions have fraud, John? Do we know?
I don't know that number.
I looked it up, and they say 10 to 30% of the transactions have fraud. And I tried to figure out, like, is this all malicious intent? Is this incompetence? Because if it's incompetence, John, I think you and I would agree that it might be a bit higher. So what I'm going to say is fraud is prevalent. If you think about what is the goal of a seller, it's to maximize value and hide your weaknesses. So there's a motivation and a payoff for doing that. So we need to be vigilant when we're doing M&A work, buying businesses. This is important work.
But let's just take the 7 top ones and start with what we can identify. We're not a forensic accountant, but things we could look out and say, all right, that's a red flag. Either pass on the deal or price the risk in. Inconsistent financial statements. I'm going to kind of read these off, and then I'm going to give the CFO, CPA, to talk about that. So look for mismatches. Compare the profit and loss statements with the cash flow statements and balance sheets. They should be balanced. There's some numbers that should match on the income statement, match on the balance sheet, match on the cash flow statement. Any major discrepancy between revenues, expenses, and actual cash on hand could indicate manipulation. And unexplained variances, large unexplained changes in financial figures, especially towards the end of reporting periods, like 5xing revenue, may suggest window dressing or fraudulent entries. So
that's right. So John, like, you need to be able to have data to figure out whether it's inconsistent, right? So getting months of data, getting 3 years of data annually, but also by month is important to look at these discrepancies. Like, if it's too good to be true, it's not true. And so, even when you're looking at financial statements, I used to have a professor that would get on a table and shout things 3 times. Okay. And then we'd all remember. And so I'm going to get on a table and shout right now: due diligence, due diligence, due diligence. Okay. So when you get these financial statements, what you're saying, John, is exactly right, is we need to look at a period of time so that we can look for these discrepancies and figure that out. You do not wait for a quality of earnings for somebody else to look at it. You must do the due diligence yourself. I know you do it, John, in your deals. You teach people to do it. I do it. We must do our due diligence at this point in time when we're looking at financial statements is really important. And so some of the things that people can do is, if you see an uptick in things, they could be changing their method of accounting. So let's change our cash basis to accrual basis. And then we just got, instead of 12 months of revenue, maybe we got 14 months of revenue or whatever it is. So you have to look and see, what am I looking at? Does it make sense? And if it doesn't, it doesn't.
I love this one as a kind of soft one, but you see the brokers always use trailing 12 months to kind of give you a better window dressing of the revenue trends. All right, let's go on to the next one.
And I like that, just on the trailing 12 months. I like the trailing 12 months if your business is changing. But what I don't like about it is many times in the business that we're looking at, they don't have proper cutoff and proper accounting for the stub periods. And so again, we're looking at numbers that may be fictitious because they haven't been validated. And we'll get to it. There's no tax return related to that. So we'll get there.
All right, the second one, unusual revenue trends, flat or declining revenues, a sharp uptick in revenue or profitability, right before the sale could indicate inflated or manipulated numbers. High customer concentration. If the business relies too much on few customers and those relationships aren't well documented, it could be risky or fraudulent.
Yeah, I mean, what can you say about this? This is pretty obvious, all of these things. But again, I'm going to reiterate that this one more time is if you look at any changes in accounting, I also ask, has the accountant been the same the whole time? That is telling.
Oh, yeah.
That's a telling one. I can tell when I get a new client. I'm like, did you change your accountant in 2023? Because now they don't know how to do job costing, And so that is a good question to ask is what is the consistency of your accounting? But this is obvious and something that everybody should look at.
All right, let's go on to the next one. Unreported liabilities. One could be hidden debts. Review the balance sheet carefully for hidden liabilities, such as unpaid loans, tax obligations, or off-the-book liabilities, or pending lawsuits. Investigate any legal issues the company might face as they can be intentionally hidden. I've seen this on a couple businesses that we looked at. There was a lot of debt coming in from an outside investor that was used to prop up the business, so it wasn't cash flow independent.
Yeah, this is something that we always have to look at. And some people that are doing maybe an asset purchase sale might be saying, we don't care, but I'm not going to take on any of those liabilities. I'm going to get an airtight agreement that says, I'm not taking on any of those liabilities, so why do I care? You might care. And I think you should care, not might, you should, because if it's off the books, it could be an expense that reduces your income. And so what we have to know is if your balance sheet is wrong, your income statement is wrong. So if you put a liability on, there's an expense, a dangling expense somewhere or something that needs to happen. So this is a really important one, regardless of whether it's a stock or asset deal.
Let me ask you a question. How do we find those hidden debts? If they're not tracking it, putting it in their books, or telling their accountant to put it in their books, how can we find those?
Well, the first step is looking over time, okay? And then the second step is understanding the industry, what's common. And then the third step is asking those questions. So you'd have to ask about lawsuits, and people hide it. I mean, again, we're talking about fraud. They might be hiding it, but you will put that in your legal agreements. And so it is a matter of, it's almost like you have to put in your forensic eyeglasses on this one, because this is really an audit-ish thing where you have to inquire, know the industry and know what you're looking for, and then look at trends too. That's the other side of the coin. Look at trends too in your expenses, and we'll get to some of the other areas. So this is an important one, but again, there's no real easy answer on this. It's inquiry, it's due diligence, due diligence, due diligence.
I'll have to tell you about this pending lawsuits. I had a client actually look at a security guard company in LA, and we discovered that he owed the IRS $1 million. And they kept telling us we think it's going to go away or be forgiven. We said, I don't think so.
No. And if it's a stock deal, you inherit the liabilities from the beginning of time. And so you would inherit that IRS, suit. So this is an important area.
All right, let's go to the next one. Overstated inventory or inflated receivables. So if the inventory is inconsistent, check for sudden or unexplained increases in inventory valuation. If inventory levels don't match revenue trends, it might indicate overstated inventory to inflate asset values. And aging receivables. Review the aging schedule of a receivables. If a large portion is overdue, it could suggest inflated receivables or uncollectible accounts being reported as assets. And I have a story on that one. Yeah, we looked at one of the businesses and we found that the receivables some of them were on the books for 1 year. I go, has anybody attempted to collect those? And we didn't want the business because the receivables were larger than the revenue. Nobody was collecting this stuff.
Yeah. I mean, I want to go back to inventory, but on receivables, here's the thing is 100% you need to ask for an aging. People can change, particularly if you're in QuickBooks, you can change the receivables and change it to a new date. So people can hide that. You can hide that. Yeah. But again, if you're looking at a bunch of old receivables, that's about discipline. If it's, nobody's waiting a year for their money, but it's about discipline and what kind of discipline is in the business. Disciplined businesses get paid. And so going back to inventory, there's a couple of things I wanted to hit on. That is, one is you want to look at the aging of inventory as well. You could be sitting on a bunch of inventory that is valued, that you think you're going to get some value from, that actually can't be sellable. So that's one thing that you definitely want to look at. And the other thing on inventory is that you want to look for whether there's changes in methodology. There's different ways to value inventory. There's LIFO, there's FIFO, there's ways in inflationary times, which is where we're at, right? There's ways to actually reduce the cost of goods sold, thereby increasing your EBITDA by just changing methods. So again, I'm going to hit on that hard. If there's any changes in accounting methodology, whether it's inventory, whether it's revenue, you want to ask for that. Have there been any changes? You want to look for that. You want to know if your accounting person has changed over the year period that you're looking at, the years that you're looking at.
Is that almost a dead giveaway sign? Is that you're going to see some changes like this? Not nefarious or malicious, but they change their accountant and you start seeing these things.
I mean, maybe. I think it's all across the board. I think most of the time we're looking at accountants that aren't the best. I think that's most of the time.
All right. Let's go to the next one. Undocumented equity adjustments on the balance sheet. Unexplained equity contributions or withdrawals. If there are sudden equity contributions or withdrawals without proper documentation, it may indicate an attempt to manipulate the company's financial position, possibly to cover up cash shortfalls or other liabilities.
Okay, well, this is my favorite and nobody else's favorite. And I'm going to tell you why. Because there are few people outside of accountants that understand how to reconcile equity. So what I find is year over year, equity should, we call it, roll forward properly. So equity comes forward, you have any capital that you've put in, any distributions you've taken out, and net income. That's it. What I find in equity are expenses that should have been on the income statement, on the P&L, that reduce the EBITDA. And so instead of putting them as a natural expense, they put them into equity. And now I'm not talking about personal items that are distributions for our owners. I'm talking about business items that they don't know what to do with, or there's a problem. So there should be no other adjustments to equity. If there is an adjustment to equity, it should be explainable to not only you, the buyer, but every accountant as well. So it should make sense. So this is a tough one because this one of the first things I do is look at, does equity roll forward and does it balance, or are things being put in there that shouldn't be in there?
Yeah. And equity should equal assets minus liabilities. That's
right.
what's used to. All right. Let's go on to the next one. Excessive adjustments or add backs. Inflated profits. Be cautious if the seller provides adjusted earnings with significant add backs. While some are legitimate, or excessive or unclear add backs might hide true financial performance. And you and I talked about this earlier this week because I showed you a sim that took a net income from $150,000 to add back STE of $850,000. It was outrageous.
Well, okay. The only thing I can say,
and then they placed the broker placed the multiple on the SDA.
I love it. So all I can say about this is if it's too good to be true, it's just not true.
Yeah.
So that's an obvious one, but I like it. It needs to be in there.
Yeah. All right. Next one. Tax returns versus financial statements. Compare reported income. If the income reported on tax returns doesn't match the financial statements, it's a red flag. This can indicate underreporting to tax authorities, which may affect the business reported profits. Now, how does somebody do that, underreporting to tax authorities?
I mean, okay, so you can do anything, Jon. If you're inspired, you can do anything.
You can. That's
you can do anything. I guess, I mean, what I'd say about this is that if your books are on the cash basis and you have your income taxes on the cash basis, they should generally match. Now, there will be book tax differences like credits or depreciation, which are normal. And that's okay. And then, but if they're different methods, a lot are different. Most of the time, if you can get away with it, you can stay on cash for a while, but your accrual basis. So, they're not always going to match, but there's no reason why you shouldn't always 100% ask for the tax returns. And you ask your people to do that, right, Jon?
Absolutely. It's the last kind of line of defense of income.
Just look at the revenue. And if you look over a period of time, again, you're looking for patterns. You're looking for patterns that support you wanting to buy it and patterns that don't make any sense. And tax return plays into that. They do not need to match 100%. They need to, if they don't match, they need to make sense why they don't match.
Yeah. Let me tell you a story that just happened recently. I have a student looking at a business on one of the online brokers, and we asked for 3 to 5 years of income statements, 2 balance sheets, and the tax returns because we're pretty serious about the business. It looked good. All they sent was 1 year of income statement. I said, well, there's no context. We can't tell what's happening. It's a 5-year-old business. So we ask again for the same documents, and then they sent the 3 years of tax returns. I said, great, but we need to match those with the income statements. They go, and the seller said, well, why do you need that? And I go, like, immediately, that is a red flag. Yeah.
I mean, yeah. Again, if somebody is not forthcoming with information, like if you want to sell your business, you want to provide information so somebody can make a decision. If that's excessive hiding. And again, excessive hiding is not appropriate. You should absolutely 100% walk away because you can't believe anything that's happening. I mean, if you were asking for the moon and the sun and everything to be combined, I understand it, but you were asking for normal things that everybody asks for. And so an educated seller knows I will be asked for these things. And if they're balking at it, they're hiding something.
Yeah. And I think that comes with a fault with probably the account manager at the broker site versus her sometimes. Like that, the account manager should be setting those expectations. These are what we're going to ask for. We're going to put them in a Dropbox and they're going to be ready to go. So
that's right.
Yeah. All right. I'm going to stop share. And I want to thank Holli for talking about the 7 red flags, how to spot fraud in buying an SMB.
Thank you very much for having me.